Mutual funds are a popular investment option for many individuals. They pool money from multiple investors to invest in a diversified portfolio of assets. These assets can include stocks, bonds, or other securities. Mutual funds are managed by professional fund managers. These managers make investment decisions on behalf of the investors. One of the key advantages of mutual funds is diversification. By investing in a variety of assets, mutual funds help to reduce the overall risk of the portfolio. Mutual funds offer a convenient way for investors to access a professionally managed portfolio. They provide diversification, which can be challenging to achieve when investing individually. Mutual funds are available for different risk appetites and investment goals. Investors can choose funds based on their financial objectives and risk tolerance. However, it is important to note that mutual funds are not risk-free. Like any investment, mutual funds carry inherent risks that investors need to be aware of. Understanding these risks is crucial for making informed investment decisions. By carefully considering the potential risks and rewards, investors can make more informed choices aligned with their investment objectives. Risk, in the context of mutual funds, refers to the possibility of losing some or all of your invested capital. It is an inherent part of investing, and understanding different types of risk is essential for making informed decisions. While mutual funds offer diversification, they are still subject to various market risks. These risks can affect the value of the fund's holdings and potentially lead to losses for investors. Market risk is the risk that the overall market may decline, leading to a decrease in the value of your investments. Interest rate risk refers to the sensitivity of bond prices to changes in interest rates. Management risk arises from the possibility of poor investment decisions by the fund manager. Credit risk is the risk that a bond issuer may default on its debt obligations. By understanding the different types of risks associated with mutual funds, investors can better assess their own risk tolerance and choose funds that align with their investment goals. Market risk, also known as systematic risk, is the risk that the overall market may decline, which can negatively impact the value of your mutual fund holdings. It is the risk that is inherent in the entire market or a particular segment of the market. This type of risk is influenced by factors such as economic conditions, political events, and investor sentiment. For example, a global recession or a major geopolitical event could lead to a broad market decline, affecting all asset classes. When the market experiences a downturn, the value of stocks, bonds, and other assets held within a mutual fund can decline. This decline in value can result in losses for investors. It is important to note that market risk cannot be completely eliminated through diversification. However, by investing in a well-diversified portfolio across different asset classes, investors can mitigate the impact of market risk on their overall portfolio. Interest rate risk is the risk that the value of your bond investments will decline when interest rates rise. This is because when interest rates go up, the value of existing bonds, which pay a fixed interest rate, tends to go down. This risk primarily affects bond funds, which invest in fixed income securities. For example, if you invest in a bond fund that holds bonds with a 3% interest rate and interest rates rise to 5%, new bonds issued will offer a higher yield. As a result, the demand for your existing bonds will decrease, causing their value to decline. Interest rate risk is an important consideration for bond fund investors, especially in times of changing interest rate environments. Understanding how interest rate changes can affect bond prices is crucial for managing risk in bond fund investments.